Okay, welcome. This is sort of part one, I think, of two parts I'm going to do on what's happening with, we're hearing about these banking crises and run on the banks. And, what does that mean to you and me? Can it mean something to us? And the word is absolutely, it can. Right now, we're not there to where we're seeing this huge contagion effect that I'm going to talk about that's possible. But I sort of want to lay the foundation as to, you know, most people don't understand how banking in general works. Now, that sounds weird, right? Put our money in, we get it out. But it's certainly more complex than that. And this first part I want to talk about is how does banking really work? Because it's actually sort of frightening in a way when you realize how that money can move around. And that's what can cause some of these crises that we're seeing right now that may continue and get worse. So the first thing to do is talk about the banking system. Uh, we'll keep this very simple. Let's go way back in time, thousands of years, the way we as human beings, we exchange goods. I have chickens, you have a sheep, your sheep produces wool and you make clothes, and I exchange my chicken for your clothes, right? Very simple bartering. And that's how mankind operated for most of its history, right? Well, let's now go back in time, not quite that far, and talk about banking, which primarily in Europe, it does predate that. But so as mankind became more astute, more affluent, more educated, and began to read and do math in a normal way, that sounds weird, but for most of history, most people could not do either one of those things. But as mankind became more affluent, it went from trading to really the creation of what we know now as money. Now, that started as really precious metals, gold and silver for the most part. That's not all. There's other precious metals, nickels, copper, things like that. But gold and silver were primarily the use in the Roman Empire. And, what happened was, and I'll use this example. This is very dramatic here. These are gold and silver coins, okay, of mine. And, these coins have a certain amount of value. Silver, 1 ounce here. Gold, 1 ounce, worth, almost 2,000 an ounce right now. This is 20 to 25. It's not that high right now, but we'll talk about that because this is very valuable in other uses like computers and solar and all kind of other things than a half ounce. So the beginning of banking in general was the local city or town, probably somebody more sophisticated that already had a little bit of wealth, opened a bank somewhere where you could securely store these items, right? Because once you had a certain amount of gold or silver or whatever the precious metal was, you couldn't just keep it in your house. Society was just a little too violent, to be honest, and raiders and invading armies. So at a point where you felt like you had to keep some of it more safe, which think of as a vault in a bank, right? And so you took your coins and you said, okay, Mr. Banker, I'd like to deposit these with you and you keep them safe. Okay. And for that, you get to keep one of these per year just to make sure it's safe. You owe me that no matter what happens. Yes. So that was the agreement. Very simplistic. It's basically, he's a custodian of your funds. Okay. So that's how it began in a lot of cases. But then, of course, the bankers ended up with these vaults filled with precious metal, all these coins. Well, humans are humans, and they began to think, well, how can I make money off that? And so then it reversed, and the banker says, well, I'll tell you what, instead of me paying me this to hold your money, let me pay you something. And he adds to your pile. But for that, I'm going to lend this money out to other people. Maybe someone's buying a farm or buying cattle or whatever it might be. And so that person said, let me loan this out. I'll still guarantee that you get it back, but let me do it. Well, all of a sudden the person that put in 10 pieces of silver is going to get back 11 at the end of the year. Wow, that's great. So that's how the systems work, and it still works to a degree this way today. Now it's certainly much more complex, and we don't have physical things. It's now data entry, basically. So this is how it began, okay? Well, then as society became much more complex, we needed to raise the complexity of how the system could work, because now, we had railroads and electricity and phones and all these things. Well, now people could do business all over the country and then ultimately the world, of course. And so we added complexity to the system. There was a bank crisis in the early 1900s, which, in 1913, there was a creation of the Federal Reserve, and there was, if you ever want to read a book you can't sleep ever again, is The Creature from Jekyll Island, was about how that all came about, where all the basically most powerful people in the world met in Jekyll Island, Georgia, and the idea of the Federal Reserve came up. I'm not going to that here, and created basically the system as we know it today to a degree. Okay, so how banking works, because let's talk about fractional reserve banking. Now, what is that? It's a fancy sounding phrase, but it's something you need to understand. Is when we take money, okay, $100,000, and we're going to put it in think of your bank right now, Wells Fargo, Chase Bank, Regions Bank, whatever it is, small bank, great. And we give that banker, here's $100,000 of my money to hold. We don't think anything about that. We know it's there when we need it. We usually don't need much at a time. We need a certain amount per month to pay bills, or if we buy a car, whatever it is, right? When we mostly use ATM cards now, we don't really carry cash around. There's not that much cash in existence, actually, when you compare it to how much, quote, money exists. So when I give a banker $100,000, that banker can loan out to other parties mortgages. They can give someone a mortgage, a car loan, credit cards, or they can invest that money. Okay, they try to earn. We'll come back to this in a second. So they're going to pay you not much. Let's just say 1%. It's been less than that over the past few years with rates so low. But let's say they pay you 1% per year on your $100,000. They're going to pay you back $1,000 extra dollars, so to speak. But they're going to try to make 3 to 4% above that in profit by investing it, loaning it out, etc. Okay? So fractional reserve banking works where I put $100,000 in. They can loan out, a rule of thumb's 90%, but it's 70 to 100%. But let's call it 90 for now. My $100,000, they can take 90,000 of that and loan it to other people. Okay. So my money's not there, right? It's not. Now the system works, and it has worked for 100 years very well, pretty much. Is we never need all of our money at once. And it's really hard to go get your money. You these days you can't really walk into a bank and say, give me $100,000 in cash back. You can, and it's a nightmarish process, but that's not really going to happen. You might take the money out to buy a vehicle. You might buy a home. You might wire that money somewhere. So that's the equivalent of taking the money out of the bank, right? So we sort of work on this system of faith that not everyone's going to ask for their money at the same time, or a lot of it. If they do, then that's what we hear as a bank run, okay? Now, if you ever want to watch it, it's a great movie anyway. We all see it at Christmas. It's a Wonderful Life, right? It explains this way better than I'm going to in the form of a beautiful story, right, about human nature. But he's running a bank, and there's a bank run. And he explains... Jimmy Stewart, great actor, he explains how banking works. He does it really well. And so for 100 years, this system has worked. There's up and downs, of course, and different type of crises, but that system has stood up over time. However, most people don't realize how much, I'm going to call it leverage, is in that system, meaning that that money is loaned out everywhere. Now, so let's get to the FDIC. Okay, that's Federal Deposit Insurance Corporation. What do? Well, they insure the first $250,000 of our deposits if we put it in a regular bank account. Okay, so if I put in $250 and a bank goes down, which is very rare, although this just happened, this is what we're going to build up to and why this might affect you. The FDIC has to pay my $250 back, okay, whether the bank survives or not. Now, if I have $500 in that account, they don't have to pay me back the full $500. They pay me back the first $250 and not the remaining $250. Okay, now we're going to come back to this because right now they're scrambling to figure out how to cover everyone because we've got some trouble brewing and a major bank failure that just happened. There's more coming. But of all the money, and there's trillions of dollars in the banking system, the trillions of dollars, the FDIC insures like 1%. I mean, it's such a small amount that if there was a failure to where, they had to cover all the deposits they even say they're going to cover, that they never could. The money is not there. Now, that expectation's not, probability-wise, it's not going to happen, meaning all banks aren't going to fail at once. And if they do, nothing matters that I'm talking about anyway. We're all going to be bartering again for chickens and wool. Nothing would matter. So, what's the backstop to that? Well, of course, it's the federal government and the Federal Reserve, and those are intertwined to a degree. They would ultimately, with large enough failures, which we just saw with Silicon Valley Bank, and we're going to talk about that because this is really, really, really important to help you understand what happened and why that could continue to happen with other institutions. And if it did, how would that affect you? So the FDIC could cover a small amount, but in general, it works. Banks really don't fail that often. Of course, during the 2008 financial crisis, we saw a lot of smaller banks absolutely fail, okay? It's a little different than what we're seeing. It's a lot different than what we're seeing today, okay? So that's banking in general, right? Okay, I put money in, they loan that money out to make money on my money. When I need it, they have to give it back to me, okay? That works unless a whole bunch of people ask for the money at the same time. So that's part one. I'm going to keep this short because that's the foundation, okay? And then now in part two, we're going to talk about what just happened at Silicon Valley Bank and why that's really important. And also how do we maybe protect ourselves against that type of risk? And we can only do so much, and you can't run around living in fear of all this kind of, that doesn't make any sense, but we can be reasonable people and try to understand how systems work to make smart decisions. So come back for part two. I'm going to post it later, assuming you're interested. I'd love for you to watch it because that's more the foundation of what I'm here to talk about. This was just kind of how the systems work in general.